Hi, my name is Mike Tusaw. I'm a financial advisor from St. Charles Wealth Management. Today, we're going to discuss selling covered calls, but selling a call spread instead of the call itself. This is a good alternative if you are in the position to where you are frustrated with selling covered calls because as soon as you sell a covered call, the stock proceeds to go up very significantly. This could be a potential solution to you. Now, if you're not familiar with a covered call, I would suggest watching our covered call video before watching this video. It might be a little bit more advanced. Now, before I proceed with this example, I want to restate something that I've been saying for almost 20 years now that I've been in the business. There is no such thing as a trade that is more risky or less risky in the world of options. Now, of course, selling 500 calls is more risky than selling one call. I'm not trying to say that. But what I mean is if apples to apples and you're not using leverage, all you're doing by using a different trade is shifting risk. So, for example, if you own a stock and you buy a put option, well, of course, you have less downside risk because the put option can protect you. However, you're shifting risk from stock price risk to premium risk when buying the put option. And there's a million examples that I could use like that. That's just the most simple one that I can come up with. What we're looking to do here is have an alternative to a traditional covered call. Now, full disclosure, I trade covered calls and I use this strategy with myself and my clients. It just depends on the situation, which one works better for what I'm looking to do. I think this is a good tool to have in your option trading toolbox. So with this example, XYZ stock's trading at $50 per share, and we want to collect some income on this. However, there is a chance that the stock could all of a sudden go up to $90 a share just because of some drug announcement, because of this, that, the other, whatever. There's some reason that we believe that this stock could go higher. That's why I love XYZ stock. It does whatever you want it to do. So what we're going to do is we're going to sell a 55 call. Now, we like the idea of selling the call for $2. We love the income on it. But I just have a hard time sleeping at night knowing that this stock could go back up to 90 and I could miss out on it. I need the income. I want the income, but I don't want to miss out on that upside. So this is a way we can shift some risk. Simultaneously, I'll buy a 60 call. And by buying the 60 call, I don't get a $2 credit anymore. I get a $1 credit because I bought that 60 call for $1. So my net credit on the trade is $1. So if the stock is 55 or lower, this is identical to selling a covered call, with the exception of the fact that you didn't quite get as much income because the stock is, the options are all going to expire worthless. So that's kind of how it would work if it's below 55. The benefit is if it's above 60, I get all the upside past 60. It's an exciting thing. I own the 60 call, so I am entitled to all that upside from that call that I own. Now, with the comparison of using this trade versus a covered call, here's where the difference comes into play. You're giving up opportunity loss between 56 and 60. So what does that mean? Well, that means that because of the fact that you got a $1 credit for this trade, if the stock goes to 56, it's just $1 that you're getting. So that's the $1 credit you're getting. That kind of breaks even with the stock getting called away at 55. But you will not be able to participate in any of the upside between 56 and 60 because of the fact that your long call doesn't go into place until a strike price of 60. So the way with which to think about this, if you want to get some income and you're willing to give up a little bit of the income you would get on just selling a traditional covered call, this could be an alternative. What does it get you? It gets you potential upside past 60. So in comparison, if you think the stock's going to be at 57, 58, you'd be better off selling the covered call because you'd get more income. But if you want to get some income and you believe the stock does have a kind of an outside chance of just making that huge run and you don't want to give up on that, this could be something to think about. If you enjoyed this video, please subscribe. That's how we get our content out to more people. Also, if you would like to work with a financial advisor who uses covered calls as well as covered calls with call spreads, look me up. Check out my website, stcharleswealth.com. You can make an appointment with me on the website. Also, follow me on Twitter. I try to put out a lot of content. Thank you and have a wonderful day.